With the presidential election season heating up, there will no doubt be a flurry of daily headlines between now and Election Day on November 5th. It's natural for some investors to be concerned about the impact of politics on the stock market and economy. How can investors stay balanced during this year's presidential election? First, be aware the stock market has performed well under both parties. Regarding our investments, it's important to vote at the ballot box and not with our hard-earned savings. When it comes down to it, long-term investors should be wary of claims that one candidate or another will kill the market or ruin the economy. Thus, it's important to separate personal and political feelings from financial plans and investments. The accompanying chart highlights the broad fact that the economy and stock market have performed well across both parties. This also occurred despite many budget battles, fiscal cliffs, debt ceiling crises, U.S. credit rating downgrades, etc. Not to mention the global financial crisis, the pandemic, and more. Not only do stock prices account for new policies quickly, but companies and industries also tend to adjust and adapt. The business cycle matters much more than who is in the White House. This is why, for most long-term investors, it makes more sense to focus on long-term fundamentals, such as those related to the business cycle, rather than day-to-day election coverage. On a short-term basis, election headlines have the power to move markets and create stock market volatility. However, these moves are eclipsed by the long-term gains created by market and business cycles. Stock market returns are positive on average across both parties. For those who are unconvinced that they should avoid day-to-day political headlines when it comes to investing, the final point is that average stock market returns have historically been positive under both parties. To underscore this point, it is not the case that markets always crash under one political party. The accompanying chart shows that no matter how you slice it, the S&P 500 has averaged double-digit gains, whether Democrats or Republicans are in the White House. While the past is no guarantee of the future, and returns in any individual year are unpredictable, jumping out of the market due to the outcome of an election, or simply because an election is occurring, is not a decision supported by history. The bottom line? The best course of action for long-term investors is to stay balanced and not make investment decisions based on political preferences. Thank you for listening. For additional information, please visit mraadvisory.com.